Imagine this. You walk into a bank, deposit $100, and walk out thinking your money is safe. But what if I told you that very same bank could, using a set of seemingly ordinary accounting tricks, turn your $100 into 1,000 or even 1,000,000 without ever actually having that money in a vault? And what if this mechanism, repeated on a national scale, quietly traps entire countries in a cycle of perpetual debt? Today, we're going to unravel the banking mechanism that does exactly that, a system so powerful, so subtle, that most people never realize it's at work. And yet, it shapes the financial destiny of entire nations. To understand this, we need to step back in time to the early days of modern banking, when the line between promise and money was first blurred. Imagine Europe in the 17th century. Trade was expanding, empires were growing, and the need for large-scale financing was exploding. Enter the first modern banks, institutions that didn't just store gold, they began issuing notes, effectively promises to pay. The concept was simple but revolutionary. Instead of waiting for physical coins to circulate, a bank could create a claim to money, lending it to merchants, governments, and traders. One figure stands out in this history, the Scottish banker William Paterson. In 1694, he helped found the Bank of England, the model for modern central banking. Its original purpose was simple: finance government debt in exchange for interest payments. But what made it extraordinary was the way it created money. The bank didn't need gold to issue a loan. It merely promised it would pay. That promise became the basis for new money entering the economy. This was a breakthrough in a trap. Because every note issued was effectively a debt, every loan was a promise that required repayment, often with interest. For decades, this system fueled growth. Nations could fund wars, build infrastructure, and support trade without waiting for tax revenue or gold shipments. But the very mechanism that enabled prosperity also sowed the seeds of perpetual debt. Every time a government borrowed, it created a chain reaction. The borrowed money circulated, generating wealth and economic activity, but the original promise, the principal plus interest, remained a liability. Over time, these liabilities stacked on top of each other, creating a compounding web of debt that never truly went away. The rise of this mechanism is closely tied to the 20th century. After World War I, countries were drowning in debt, and the world needed a system to stabilize it. The creation of central banks in nearly every major nation, coupled with flexible monetary policies, meant that governments could issue more promises than they had actual resources. In practice, this meant that money itself became a kind of perpetual IOU. Economists call this fractional reserve banking. Banks only need to hold a fraction of their deposits in reserve, allowing them to lend out the rest. This amplifies the money supply, but also amplifies debt. Every dollar in a bank could theoretically become $10 in loans, creating new promises faster than the economy could produce real wealth. This system worked beautifully until it didn't. The breaking point comes when promises exceed reality. In 2008, the global financial crisis exposed this flaw. Banks had lent far more than they could safely cover, creating a domino effect of debt that governments had to bail out. Suddenly, the invisible mechanism that seemed to generate endless wealth revealed its dark side. It traps nations in obligations that are nearly impossible to fully repay. Modern governments today owe trillions, and interest payments alone consume vast portions of national budgets, often funded by issuing yet more debt. It's a cycle that looks like growth on the surface, but underneath, it's a treadmill of promises paying promises. The fallout from these cycles is enormous. Citizens feel it through austerity measures, rising taxes, or inflation. Entire generations inherit debt they didn't create, while a handful of financial institutions and elites often benefit. Attempts to break free like debt forgiveness programs or stimulus packages temporarily ease the strain, but rarely address the structural mechanism. Each fix tends to generate new promises, new debt, and new dependency on the banking system. This isn't a conspiracy theory, it has arithmetic. Promises compound faster than the wealth that underwrites them, especially when governments rely on borrowing to fund daily operations. Look at today's numbers, and the pattern is eerily familiar. The U.S. national debt is now over $35 trillion. Japan's debt exceeds 250% of GDP, and many European nations carry obligations that would have been unthinkable a century ago. Even with economic growth, these debts grow faster than the capacity to repay. Each loan issued by a central bank, each treasury bond sold, is another promise layered on top of previous promises. And yet, because the money exists in circulation and fuels trade, the public rarely perceives the danger until a crisis hits and the illusion is shattered. The parallels don't stop there. Private banking, corporate finance, and even student loans operate on similar mechanics. Essentially, the system converts promises like "I owe us" into real-world obligations that ripple through economies. Every sector, from housing to education to national infrastructure, is touched by this invisible web. And the more the system is relied upon, the more inescapable the cycle becomes. History has shown us that human ingenuity can generate wealth, but it is the structural design of these financial promises that often dictates long-term outcomes. So, what can we take away from this? First, understand that money today is not what it seems. Most of what circulates is not physical cash, it is promises, debt instruments, and IOUs, all layered into a complex, self-reinforcing system. Second, recognize that growth fueled by debt is inherently fragile. Prosperity on credit is not the same as prosperity grounded in real production. And third, be aware of the invisible treadmill. The more a nation borrows, the harder it becomes to break free, and yet most citizens are unaware they are participating in it every day. Here's the chilling part. The cycle doesn't need a villain. No single banker or politician creates perpetual debt. It's a product of rules, systems, and incentives that reward lending and borrowing while punishing restraint. And unless these structural mechanics are understood and addressed, the pattern will repeat itself, just as it has for centuries. So, what does this mean for us as individuals or as citizens of a country? It means we must ask deeper questions. How much debt is sustainable? How are promises being transformed into obligations we cannot escape? And are we prepared for the next financial turning point when accumulated promises collide with reality? The answers are neither simple nor comforting, but asking these questions is the first step toward awareness. If this story has sparked your curiosity, the next step is to watch how it unfolds in real time. Observe central bank policies, government budgets, and even the credit systems we interact with daily. Understanding this mechanism doesn't just make you financially literate. It gives you insight into the hidden forces shaping your economy, your community, and your life. And if you want to explore more stories like this, untold histories of economics, finance, and the invisible systems that govern our world, make sure to subscribe. Hit the notification bell and join our journey. Because the deeper you look, the more you realize that money is not just coins and notes. It's a story of promises, power, and perpetual cycles, and it's a story that affects every one of us.